The story of the crypto winter does not begin in the frost. It begins in fire. In January 2009, while the global economy was still limping from the wreckage of the financial crisis, an anonymous figure, or perhaps a group, calling itself Satoshi Nakamoto, released a 9-page white paper. Its title was spare, technical, and almost unassuming: Bitcoin, a peer-to-peer electronic cash system. The world barely noticed. A few cryptography enthusiasts passed the document among themselves, intrigued by its mathematics, its elegance, and its defiance. Yet hidden in its lines was an idea that would spread far beyond the bounds of code. A currency that required no central bank, no government, no permission. A system where trust was transferred not through institutions, but through algorithms, immutable, transparent, incorruptible. In those first months, there was no market. Early adopters mined Bitcoin on home computers, trading it like curiosities. In May 2010, the first recorded transaction took place. 10,000 Bitcoins for 2 pizzas. At the time, it was a joke among hobbyists. In hindsight, it was the planting of a seed that would one day shake the foundations of global finance. As the 2010s unfolded, the fire spread. Startups emerged in San Francisco, Zurich, Singapore. Exchanges began offering seamless conversions between fiat currency and crypto. Venture capital poured into blockchain projects promising everything from decentralized finance to immutable digital art. Ethereum launched in 2015, enabling smart contracts and unleashing a wave of experimentation that would expand the ecosystem far beyond a single coin. The movement was not merely technical, it was ideological. In New York cafes, London pubs, and Manila co-working spaces, the conversations pulsed with the same undertone: liberation from the gatekeepers of money. In countries battered by inflation, Venezuela, Zimbabwe, Turkey, crypto offered a lifeline. In developed economies, it was framed as an investment frontier, one where ordinary people might leapfrog the slow climb of wages and savings into sudden wealth. By the late 2010s, exchanges were processing billions in daily trades. ICOs, initial coin offerings, became the new IPOs, promising life-changing returns to anyone willing to buy early. The landscape grew crowded with tokens, each with a story, a dream, a promise. Social media amplified the fervor. Every price surge was a headline, every new millionaire a legend retold. For retail investors, nurses in Manila, shop owners in Nairobi, delivery drivers in Berlin, the barrier to entry was lower than any asset class before it. All one needed was a smartphone, an internet connection, and the will to take a chance. Apps offered instant account creation, fractional purchases, and glossy interfaces that made the world of high finance feel like a game. And like all games, it was addictive. Yet history has a way of casting long shadows over moments of unbridled optimism. Economists studying the boom saw echoes of earlier manias: the tulip frenzy of 17th century Holland, the South Sea bubble of 1720, the dot-com surge of the 1990s. The patterns were familiar: the rapid influx of capital, the belief that old rules no longer applied, the conviction that this time was different. Still, in those heady years, it was easy to ignore the warning signs. Bitcoin crossed $20,000 in 2017 before tumbling, only to rise again with even greater force. Ethereum's price multiplied by 100 in less than 2 years. New protocols promised 15%, 20%, even 40% yields on deposits, returns that in traditional finance would have been dismissed as impossible, but in the crypto sphere were heralded as innovation. And so the gold rush deepened. Miners expanded operations into massive warehouses, consuming enough electricity to power small nations. Trading floors emerged in converted lofts, glowing with the light of a dozen monitors, where young traders chased momentum from dawn to midnight. At conferences in Miami and Dubai, Blockchain entrepreneurs spoke of ending poverty, replacing banks, and reshaping the internet itself. The inflow of capital was staggering between 2020 and 2021, spurred by pandemic-era stimulus and historically low interest rates. The total market capitalization of cryptocurrencies soared from under $200 billion to nearly $3 trillion. The tides and currents of global liquidity, once anchored in bonds, equities, and commodities, shifted into the digital realm. It was in this fevered atmosphere that the seeds of the coming winter were planted, not in deception, though there was plenty of that, but in overconfidence. Investors forgot that markets, digital or otherwise, still bend to the same gravitational forces: supply and demand, confidence and fear, greed and caution. The same pendulum that had swung toward euphoria would, in time, swing back toward despair. For the newcomers, the delivery driver in Sao Paulo, the student in Seoul, the retiree in Manchester, the dream was intoxicating. Many poured in their life savings, convinced by charts, influencers, and the testimonies of early adopters who had turned hundreds into millions. In those moments, winter seemed inconceivable. After all, who worries about frost when the sun is at its zenith? But as history would remind them, the sun never stays at its peak, and somewhere beyond the horizon, the first faint chill was already in the air.